February 5th, 2025. The first thing just close the market. First thing I want to highlight is bar 7. Whenever you get a really big surprise bar around the open, like bar 7, you're going to get a measured move of the bar, but it could be in either direction, right? So you can see we got a reversal up, and once we broke above this high, odds were that we were going to get the measured move up rather than any sort of measured move down. So when you get really big surprises on bar 7, or just in general, sometimes it'll be consecutive bull bars on the open or consecutive bear bars on the open that are, surprise bars like bar 7, way much bigger than most bars. You do have to keep in mind that you are probably going to get a measured move either way. Bar 1, a bear bar, but a large tail on the bottom. It looks like a second leg down. The first leg down, 78, 79. Bar 2, a bull bar, a tail on the top. Not really great to do anything yet. It's looking like it's going to be a trading range open. 3 is a low 1 short, but it's a low 1 short after 2 legs down, so it might be a third leg down. 4 consecutive bear bars, 3 and 4. We're probably going at least a little bit lower. I'm not sure how much lower. We're probably going to need follow through, which we do get on 5. 3, 4, and 5 are good follow through bars. We might get a measured move down of some kind, but I don't like to trade before bar 7 personally because of this. This is the exact reason why I don't trade before bar 7 usually. It's because you can get these really, really large moves that are really difficult to trade. 6, a bear bar, but a large tail on the bottom. It's 4 straight bear bars, but a huge tail on 6 makes it not as good of a sell. Traders are likely going to look to sell higher. And then a big outside down bar on 7. Do you sell the close of 7? No, I would not. It looks like 3 legs down. The first leg, 78, 79. Second leg, 1 or 6. And then obviously, 7, leg 3 or leg 4, however you count it, is bar 7. 8, a wedge bottom, a bull bar closing your tie. It's one of those trades you can take and just kind of take a chance that it's the low of the day, but you can't buy above 7, you can't buy above 8 and then just scalp out. If you're buying above 8, you have to understand your premise. Your premise of buying above 8 is that it's the low of the day, more or less, right? And that we're going to get above bar 7. If you're buying above 8, you're basically saying, I think that we're going to get the measured move up of bar 7. So if you're buying above 8, you probably want to go for some sort of pretty ludicrous profit target, like somewhere up here. And yeah, maybe there's only a 20 to 30% chance you get it, but you're risking 10 points trying to make 40. So if there's a 30% chance of success, it's a profitable trade. Follow through bar on 9. It's notable that traders bought the 50% pullback of 8 instead of buying the 25% pullback. It's just slightly increases the odds that it's a trading range. You can see of 8 and 9, they bought a 50% pullback, right? So instead of buying the close of 9, traders bought a 50% pullback. What did they do with 11 and 12? They bought a 50% pullback. So, this is going to have to get stronger if we're going to go a lot higher. And obviously, it did get stronger. So 10, a bear bar. You can buy the close of 10. You know that 8 and 9 is going to get a second leg up. But buying the close of 10, you need to see bar 11 basically as your calibrated expectation if you're buying the close of 10. And 7 still might get a second leg. It just kind of depends on if we continue to rally. If we start to get a convincing reversal down, I think a lot of traders will start to look to exit. So I believe I was on 11, a bull bar closing your tie. You can buy above 11. Some traders, like I said, will buy above 8. Some will wait for 9, more confirmation. Some will wait for a high 1, like bar 10. Some will wait to buy above 11. It's all by the close, really. 12 consecutive bull bars, 11 and 12. We should go higher. And then 13 is a 50% pullback of 11 and 12, as I mentioned. 14, a bull bar, 3 legs up. 9, 12, 14. We're probably going to go a little bit more sideways rather than straight up. But ultimately, I think we should go higher. The thing you have to keep in mind, I'll finish talking about these bars, but the thing you have to keep in mind is that this is all a breakout on a higher time frame, right? This whole move is going to get a second leg up of some kind. And, even you could argue include the move to bar 21. Really, it just depends if we get, what the pullback looks like and, how far the pullback goes. What I mean by that is if we go sideways for 10 to 15 bars, it's really just, these are breakout bars on a higher time frame. And we're still probably going to go higher. So tight channels are breakouts on higher time frames, which is why tight channels generally get second legs. 16, 15, 3 pushes up, probably buyers somewhere below 15, but it might get a second leg sideways to down simply because it's 3 legs up. 16, a good bear bar, but a large tail on the bottom. Probably buyers not too far below, probably sellers not too far above. 17, a bull bar closing near its high. Good for the bulls, but I don't know how much higher we're really going to go here. We're probably going to need to start to go sideways. If you're buying above 17, we already have 3 legs up. And when we have 3 legs up, we should get 2 legs down. So buying above 17 isn't exactly the best trade in the world. 18, disappointing. Obviously, if you do buy above 17, you would need to use a wide stop. 18, disappointing, but not that surprising because we should get a second leg from 15 and 16. 19, a bull bar, but a large tail, and then follow through on 20. It's still 3 legs up, though, 3 or 4 legs up, however you want to count it. The only way you could really exit would, if you had bought somewhere in here, would be if your stop was below 17 on this sell-off, which does make some sense. However, when you get 3 legs up, the market will often trade below the third leg and then rally back up. So you could argue, this is the third leg or this is the third leg, whatever the last leg is, the third or the fourth leg. It'll oftentimes trade below that and then reverse back up. So, while you could have a stop below here, a stop below 13 probably makes a lot more sense because it's below the low of the second leg. If you just go through and look at all the times where the market gets 3 legs and then 3 legs up and then trades below the third leg, a lot of times it'll reverse back up to at least the extreme. 21, a bear bar, a large tail on the bottom, probably buyers somewhere below, but we should get back to the bar 20 close. 22, consecutive bear bars, large tails on the bottom. So again, I don't know if we're going that much lower. The bears probably need one more bar. And instead they get a doji bar on 23. 23, you could argue it's a higher low major trend reversal, but I don't want to buy above a doji bar. It's better to wait for 24. And 24 is strong enough for at least 2 legs up, so you can simply buy the close of 24. Or, you know that we're going to get a second leg, right? So you could have bought the close of 24 and realizing that the first leg up was the tight channel from 8 to 20. You could buy the close of 25, consecutive bull bars, 26, 3-bar micro channel. I like to buy that close. 27, another buy the close bar. So we have 4 straight bull bars. You can buy any of these closes. We're going higher. Very high probability of at least some sort of second leg. 28, another bull bar, tail on the top, but still going higher. And then 29, a large bull bar. It's climactic. We're probably going to start to go sideways soon, but we're probably not going very far down. 30, an inside bar, a high one, but relatively high in a trading range. So I would not buy above 30. 31, a bull bar, good for the bulls. And then 32, consecutive bull bars, but a large tail. We're probably going to trade back below 30 because 29 is a climactic bar, which is usually where the trading range starts. So a lot of times the market will try to test the low of those climactic bars, like 29 low. Try it over here. 32, so 33, a bear bar, but a large tail on the bottom. Not worth selling, but not really worth buying since we're probably going to go at least to the 30 low. Or as I mentioned, the 29 low. I was personally thinking more of the 29 low or close the gap with 28 high and the 30 low. That actually might be what ended up happening. Yeah, I closed that gap. It's an exhaustion gap, right? Whenever you get a climax bar like this, the gap it creates is generally exhaustion. 34, another bear bar, but a large tail on the bottom. 35, 3 straight bear bars, but large tails. 33, 34, 35, parabolic wedge, lower time frame. 36, an inside bar, probably buyers below. Disappointment. 37. Really, what's the goal here? I can go bar by bar, but what's going through your mind as you're watching these bars form is what needs to, what you need to focus on. And the only thing you should be thinking about, if we're in this range, selling should never have crossed your mind anywhere in this range. If you're taking some crazy quick scalp, you don't need to do trick shots in trading. It's pretty straightforward to buy closes and hold and look for more legs up. A lot of people try to get really fancy with the way that they trade, and that usually costs them money. So if you keep it simple, you have a better chance of making money. So selling really should never cross your mind in a tight trading range like this after such a strong bull leg. It's difficult to want to buy above any of these bull bars. Theoretically, you could buy above 39, 45, or 40, 49, but you have to keep in mind, this is still a magnet somewhere down here. So if you're going to take any of these buys, your stop should probably be somewhere in this area. Maybe, theoretically below 25, below 25 since spike and then a pullback. This was, in a way, the start of the channel of the spike. So a stop below 25 makes sense. And you say, well, that's a really small position size. Yeah, it is. But you're basically, looking to get out if you get consecutive bear bars. So it's really, you're not going to let this stop get hit. If you get consecutive bear bars closing near their lows below the moving average, let's say 48 close on its low, you can just get out. And once you break above the trading range, 50, you can buy the close of 50 and then pull your stop to 48. So the problem that people have with scaling in is that they usually add too quickly. They'll buy above 39 and they'll put a stop below 25. And then they'll buy more on 40 and then they'll buy more below 40. And then they'll buy more above 45. And then their position size is huge. and it's way bigger than they intended, and then they get scared and put their stop below 41, and they get stopped out during 48 and watch it go without them. So we obviously had the bull spike, and then another 3-bar micro channel here, a really deep pullback, 4 legs down, and then you could buy above 66, taking a chance that we at least rally back to the bar 57 close, since this is going to be a magnet. Traders will do that, or they'll buy the close of 68, and you're usually not going to go too far above the extreme when it's in a bull channel. You can see we're obviously in a channel phase 1, 2, 3, or 1, leg 2, leg 3. So this is leg 3. So better to probably stay away from this type of trade. I did buy this close today, and I bought more at 50%, and then I ended up exiting at the close of 56. I basically broke even today. I bought this close 2026, and then I did 2 really dumb things. Where basically what happened was I got a little too overconfident because I had done really well the past, not the past 2 days, but the last month I did very well. And I basically came into the month just a little bit arrogant, and arrogance is going to get you killed in the stock market. So I didn't do very well on either one of these days, and I spent most of my time studying instead of making a video because I just felt like I needed to do that. But today I basically broke even, and I'm happy with the trades that I took, except for the 2 that I'll tell you what I did. I bought the close of 21, which you should only do in leg 1, like buying the close of 10. But I just made a bad decision, and then I sold the low of 21 during 24, and then I just exited during 24. Neither one of those things is within the parameters of what I like to trade in, but I just just generally took bad trades because they were outside of the systematic way that I like to trade. And what's really too bad about it is the way that I do like to trade, kind of within the system, is just front running the 3-bar micro channel. So you get something like 24. I know we're probably going at least above this high because this should get a second leg. This whole rally to 20 should get a second leg. So I know we're going at least above the bar 21 high, and I can buy the close of 25 as well. And then by the time it's 26, it's the 3-bar micro channel, but I'm already in, right? I was in at a lower price. So I get even better risk reward and a better chance to make money. So you essentially learn how to front run your system, but if you just don't act silly and trade outside of it, you'll find a lot of times you do pretty well. A bar like, trades like bar 8, the real problem with swing trading instead of just buying closes is that when you miss this trade, this is the one that's going to make up for all the losers. So if you bought above 8 today, that's fine. You took a good trade. Or you could wait for 9, follow through, and just buy the close and hold. But if you're going to buy above 8, you kind of have to just hold it, because if you buy and you scalp out, well, what about the 7 out of 10 times where this trade loses, or 6 out of 10 times where you can't even make a scalper's profit, right? This sort of day where you're able to make, 47 to 50 points, something like that, is really going to be what makes up for, all of those losing trades. And that's kind of what makes swing trading difficult, is that you have to take every single one rather than being able to be a bit more selective, like with buy the close trades. Because, you 24, 25, 26, very high probability we're going to go higher. So you can just buy the close of 25, buy the close of 26. As a beginner, if you're a beginner, I think the best thing you can do is, whenever you're scared, if you're seeing this 24, 25, 26, and you felt fear, like you wanted to get in, but you were too scared to buy because it might pull back, that should be your radar for smashing the buy button, with just hammer the buy button whenever you're thinking, oh my gosh, it's going to pull back. When it's starting to trend like this, when you're getting these micro channels and you're scared it's about to pull back, just slam the buy button, because you're going to get a second leg up. And a lot of times it'll just keep going. So obviously that technique takes a lot of practice, and it's going to pull back a lot of the time. But what you're going to find is the pullbacks aren't, the pullback isn't just a giant bear buy that stops you out. The pullback is maybe a 40 to 50% pullback, and then it goes back up. And eventually you learn to add in on those pullbacks. We've had a channel over the past couple of days. Whenever you get a major breakout, this is another perfect example. You can just buy the close of 11. It's a 50-point bull bar. How many times in your life have you seen a 50-point bull bar? It's going to go higher. Buy the close of 12. We have a 65-point rally right here. Just buy. It's going to end up going higher. But anyways, bull channels in general last 2 to 3 days. And this is, or 200 bars. And I believe we're right around 200 bars. 200 bars is what it's in Al's book, but this is 230 bars. So this channel has been going on pretty long. But this is not like a a really, really strong bull channel. It's relatively weak bull channel. It's covered 60 points in 3 days. That's not a whole bunch. So, what usually happens at the end of bull channels? Well, it becomes a trading range. And only in general, 25% chance of a strong breakout above. So 25 to, if it starts to happen, it becomes more obvious because you start getting really strong bull bars. But if we start to get really strong bull bars, then we could get a breakout above the bull channel and go for a measured move of the bull channel. More likely, said breakout fails and it turns into a trading range. Where's the low of the trading range? I don't know. I mean, the higher lows, this low, this low, this low, or the 12 low, which is probably the very bottom of the channel, are usually pretty good measured move targets. And if you look, the initial spike, 11 through 13, does get the measured move up. So if you had bought and just held, you would have made money. On the daily chart, 3 straight bull bars. So bull micro channel. Oh, okay. Well, not if you include extended hours, which I like to. But basically, the bulls who bought this close, they got this bear bar, but it doesn't seem like they were that disappointed because they kept buying. We should go to a new high. You could argue, I think it's 1 pullback, 2 big legs down. And this is a big high too. We should get back up to this high. At least that's my opinion. The weekly chart, we're probably going, like I said, higher. I'm expecting us to go higher. If you think about the monthly chart, it's nothing really that great for the bears yet, at least. A lot of people think we're going to pull back, and I'm one of them. But one of the problems is you just, predicting pullbacks on the monthly chart is it's really, really hard to do. So it's better to just, hold long until something blatantly obvious happens, or you get something that needs a second leg. The bears haven't gotten anything that needs a second leg. And quite frankly, if you sold this low with a stop above here, I think you're getting stopped out. So we should go at least 1 tick above that high. But all right, that's gonna be it for this video. I will make a video tomorrow, and I'll make one Friday too, or this weekend or something. But yeah, that's it.